Who is the Fed blaming? Trump's tariffs or their own inaction? Jerome Powell said, "If it weren't for the Trump administration's tariffs, we would have been able to cut interest rates sooner." Sounds reasonable, right? At first glance, you might think, tariffs increase prices, so it makes sense for the Fed to keep interest rates high to curb inflation. But let's think a bit deeper. Inflation is falling. No one is buying homes. The economy is showing clear signs of slowing down. Yet the Fed is still stubbornly holding interest rates sky high. So, is this data-driven monetary policy, or is it a political maneuver? The Fed's argument: tariffs increase prices. Fed can't lower rates. Let's look at the Fed's argument. Chairman Jerome Powell and many other officials continuously cite the impact of import tariffs. They say these tariffs, imposed on goods from China and other trading partners under Mr. Trump, have pushed up consumer prices. This, they argue, creates new inflationary pressure, or at least hinders the process of bringing inflation back to the 2% target. Therefore, the Fed needs to be cautious, patient, and data-dependent. These are the catchphrases used to justify delaying interest rate cuts. They worry that cutting too soon would ignite a new inflationary spiral. It sounds plausible in theory, but does it hold true in reality? Counter-argument 1. CPI is not rising. Real data shows inflation is falling. The real data is telling a completely different story, directly refuting the Fed's inflation fears. The Consumer Price Index, CPI, for May 2025 only increased by 0.1% month over month. This is an extremely low figure, indicating almost negligible price pressure. Core inflation, core CPI, which excludes volatile energy and food prices, has fallen to just 2.8% year over year. This figure is already very close to the Fed's 2% target. Even the Producer Price Index, PPI, hasn't increased significantly, showing that input costs for businesses are stable. If the reason for keeping interest rates high is fear of inflation, then the data has completely disproven that. The Fed is chasing a ghost, not reality. Counter-argument 2. The housing market is frozen, a direct consequence of high interest rates. Let's look at the housing market. Mortgage interest rates remain above 7%, sometimes even touching 8%, the highest level in over 2 decades. This makes homeownership incredibly difficult. People are stopping their home buying plans, hoping the Fed will lower interest rates soon. But the Fed keeps holding high interest rates, causing the entire real estate market to nearly freeze. And real estate isn't just about homes. It drags down a whole host of other industries. Construction materials, furniture, electronics, banking, legal services, all are heavily impacted. Keeping interest rates high on the pretext of fearing inflation is actually dragging the entire economy into stagnation. Counter-argument 3. Tariffs are a supply shock, not a reason to keep interest rates high. This is an extremely important point. If product prices rise because of tariffs, that's due to a supply shock, meaning production and import costs increase. It's not because aggregate demand suddenly surges, but the Fed's interest rate tools are primarily effective in controlling demand-pull inflation. That is, when too much money is chasing too few goods. Therefore, using interest rates to fight tariffs is like using a sledgehammer to fix a watch. It's a misguided policy, flawed in theory, and harmful to the economy. Counter-argument 4. Lowering interest rates helps people absorb the impact of tariffs. In fact, lowering interest rates could help people absorb the impact of tariffs. Reduced interest rates would directly ease the burden of debt for people, especially those with mortgages or variable-rate consumer loans. The money saved from lower interest payments could help them afford essential goods like food, gasoline, and clothing, items whose prices might have increased due to tariffs. Instead of providing support, the Fed is not only failing to effectively combat inflation, but is also pushing American citizens, especially low and middle-income households, into financial exhaustion. Counter-argument 5. The bond market is signaling, cut interest rates. Even the bond market is sending a clear signal. Government bond yields are falling. What does that mean? It means the market believes inflation will continue to decline, and they are expecting the Fed to cut interest rates. If the Fed is truly data-dependent as they claim, why are they going against such clear signals from the market? Are they ignoring the most important indicators? Counter-argument 6. Waiting for more data is a political excuse. Powell says the Fed needs to be cautious, consider more data, and be patient. But let's look at the facts. CPI falling? It's clear. The job market stable? It's clear. Consumer confidence declining? It's clear. Business investment decreasing? It's clear. The data is already overwhelmingly clear. The issue isn't a lack of data. The issue is, this is a presidential election year. The Fed doesn't want to be seen cutting rates under Trump because they fear being accused of politicizing monetary policy. This caution might just be an excuse to avoid making politically sensitive decisions. So the big question is, who is truly controlling U.S. monetary policy? Is it objective economic data or complex political pressures? How much longer until the American people can breathe easy before the Fed realizes that inflation is no longer the problem, but their very own policies are stifling the U.S. economy? What do you think? Is the Fed being stubborn, or are they hiding something bigger? Please leave your comments below, and don't forget to share if you believe this truth needs to be heard.